Let's say you feel very strongly that a security will move one way or another. You might want to double or even triple down on your position to potentially earn an even greater return. Well, there are leveraged exchange traded funds that can help you do just that, if you're willing to accept the risks that's associated with them. Let's hear more about how they work and how sophisticated traders can make the most of them. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Jason Natick. Joining us here today is Chris McHaney. He's the Executive Vice President and Head of Investment Management and Strategy at Global X Canada. Chris, it's great to have you here with us today. We appreciate you taking the time.
Thanks, Jason. Happy to be here.
Now, Chris, you're relatively a new addition to the Global X Canada team. Can you tell us maybe just a quick synopsis of your professional experience in the ETF industry?
Sure, yeah. I have more than 20 years experience in the financial services industry here in Canada, and the last 15 directly associated with ETFs. That involved managing index portfolios, but active portfolios as well, multi-asset and derivative focused is really where I spend a lot of my time. So very familiar with ETFs in general here in Canada and very knowledgeable about the ins and outs for investors to pay attention to.
All right, so a wealth of experience, just to sum that up, so our audience is in good hands in today's discussion. All right, so let's talk about the topic of the day here. Leverage ETFs are amongst the most highly traded on platforms such as ours here, Webroker. Why do you think that is?
Well, I think, we'll get into some of the features and benefits of these type of ETFs, but, really they can be very powerful trading tools for investors that have a short-term focus and have high conviction potentially. They tend to be very short-term in nature in terms of how investors should be using them. And so you can see a lot of buy that ETF one day and sell out of it potentially even that same day. So it involves a lot of trading activity in general. So not surprised to hear that they are among the most actively traded.
All right, great. So I'm really excited to unpack the ins and outs of leverage ETFs. But before we get into our conversation, just a quick note to our viewers. We're discussing an investment product that inherently itself has leverage, and they use that to achieve their investment objectives. Leveraging to invest carries heightened risks of losses as well as gains, so make sure that you understand these products carefully before you trade them yourself. You can check out the fund's prospectus to get a better understanding of how they work. All right, with that said, let's jump into it here. First off, let's lay a little groundwork for the audience. For those that may not be familiar with leveraged ETFs, how does it work at a high level?
Yeah, and maybe just, what is leverage, right? I mean, leverage involves borrowing to invest to potentially have a higher return experience. In a simple way, think of someone who might have $100 to invest. They can also borrow another $100 and invest that as well, and all of a sudden have $200 of exposure to that underlying investment. And so that's in essence what leverage is. Gives you a better chance of a higher return based on what you've invested, but as you say also on the downside can increase that risk and has a higher risk to the downside also.
So we're talking about borrowing inside of the ETF itself. Is there any other kind of investment products that the fund may use to achieve that leverage?
Traditional leveraged ETFs that provide that 2 times exposure that we're talking about inside the ETF itself actually uses a financial derivative to gain that, to amplify that return potential. And so, that actually benefits investors to use that ETF because that limits your potential loss to the amount invested. Of course, again, if you're borrowing yourself, you have a higher amount of capital at risk than what you've actually invested on your own. But that ETF that does that transaction within the ETF itself for you limits that potential loss to the amount invested in that ETF. But also it just makes it a lot easier for investors to be able to just buy a financial instrument, that ETF, rather than making sure they have a margin account open, tracking how much you've borrowed, how much interest is earning on that borrow. And so, having a nice, neat package that just makes it very easy is a great way for investors to use leverage and just use it within that ETF solution itself.
Smarter, not harder. That's maybe that's not always a rule that I implement successfully all the time, but it's one that I like to try. So this seems to kind of square that circle for me. So I like it.
That's right.
All right, now some ETFs use, when we're talking about leverage ETFs, they use low amounts of leverage, while others have a more of a moderate degree, maybe 2 or even 3 times. What are the key differences that investors should appreciate between these types of products?
Yeah, the traditional leveraged ETF is that sort of 2 times exposure on a daily basis, and that's largely what we'll be talking about today. But a more recent development in the ETF industry is, as you say, providing ETFs that have a lighter amount of leverage, and that's more like call it about 25%, for example. So for every dollar an investor would put into a lightly levered ETF, they would get 1.25 times exposure to that underlying ETF. And so those sort of solutions are really meant more for the buy and hold type investor. They maintain that amount of leverage, again, let's call it 25% as an example. In and around a band, they maintain that over a long period of time. And so that's a solution that investors can potentially use to just buy and hold throughout time to gain that upsized potential exposure. The more traditional, as I said, 2 times levered ETFs, those are really more designed to be short-term in nature. And again, I mentioned that a little bit earlier, but really for as little as 1 day, someone can hold that. And these are really used more for trading and speculation on the price movement of a stock or an underlying investment, again, over a very short period of time. So those are really 2 different solutions. Again, one a bit more buy and hold that has that lighter degree of leverage, but those that carry a little bit more leverage, 2 times or more, are really meant for those really short-term strategies. Again, 1 day or potentially even less.
Now, outside of the name of the fund itself, what would be a kind of the easy way for an investor to kind of understand if their fund has leverage at all, and if it's moderate or low? Like, what would be kind of good rule of thumb there?
Yeah, I mean, that's a great question because it could be tricky on investors, especially with a lot of different products being brought to the market. It's not always apparent, again, as you say, just from the name of the fund. But really, it does come down to the investor educating themselves, looking at the prospectus, understanding how this ETF is building its exposure, how often that leverage resets, as I mentioned. It could be daily, it could be over a longer period of time. And so also understanding what the underlying investment is, whether that's an equity index, whether that's a commodity price, or what have you.
All right, so we started kind of going down that rabbit hole a little bit about individual funds. What are some examples of some moderately leveraged, as well as inverse, which is a kind of an interesting concept, the ETFs that are out there that investors might see?
Yeah, and so for example, we'll start with an investment where, let's say you're bullish on a particular sector. For example, the Nasdaq. You might be interested in the Nasdaq 100 2 times daily bull ETF. And that's going to provide you 2 times exposure to what the Nasdaq does on that given day. So again, if an investor is really bullish and thinks the market is going up that day, you might look at that 2 times daily bull ETF. Similarly, there are 2 times daily bear ETFs, which provide an inverse double exposure. Again, let's use the Nasdaq as an example. If you're bearish on the Nasdaq and think it might be going down, you would buy the Nasdaq 2 times daily bear ETF, and that would profit from the underlying index going down. And so the third example, as you referenced, is the inverse ETF, which is very similar to that daily bear ETF, but instead of having 2 times exposure, it's just that 1-for-1 exposure. So if you think, again, let's use S&P now this time as an example. If you think the S&P might be going down, you can buy that S&P daily inverse ETF on the S&P 500 and profit from a decline in that underlying investment.
Now, just to really kind of hit the nail on the head and to kind of clear up this from a risk perspective to the investor. So if I'm buying a daily 2 times bull Nasdaq, what if the Nasdaq goes down? What can I expect to happen to my position?
If the market goes up and you're expecting it to go up, you have that double exposure to the upside. But similarly, if the market goes down, you're gonna have that full risk 2 times to the downside as well. And so just think of an example where the market goes down 1%. Your daily bull ETF would go down 2% in that scenario.
That's good. Really just making sure we're clear on that, so the audience has a really nice perspective of kind of that risk-reward paradigm that they're taking on in their own portfolios, and making sure it aligns with their own objectives. All right, so why do moderately leveraged ETFs and inverse ETFs, like those at Global X in your Beta Pro series, why do they reset that the leverage on a daily basis?
Yeah, and I kind of briefly touched on it earlier. The way that financial derivative contract works within these strategies, so that they don't have to borrow money and bring margin and invest directly in that investment. Using that derivative contract, really helps to control the risk by resetting it daily. If the market rallies several days in a row, a 2 times ETF that doesn't rebalance can start to carry more than 2 times exposure. And so you can really start to drift away from that targeted exposure that you want to provide. And so by resetting these contracts daily, it limits the risk to the amount invested for the investor, but it also keeps it precise in terms of what that exposure is in that ETF. That every single day as an investor or as a trader, that these 2 times ETFs, for example, are going to give you exactly that 2 times exposure on that given day, without having to look up, what's the leverage amount today, how far has it drifted. So really it's about precision in that offering and letting investors know exactly what they have in that solution. Throughout the day, there's movement in that underlying index, in that underlying asset, whatever that is, whether it's, again, a commodity price or a equity index and what have you. And so at the end of the day, the solution really restructures or resets the amount of leverage based on the market movement of that day, based on the amount of subscriptions that have come in or redemptions that have come out, and calculates that new asset value and resets the amount of leverage based on that asset value at the end of the day. So again, when investors come back the next day for the next trading day, they know that they are exactly at 2 times exposed to that underlying investment.
Clearly, there's a lot more hands-on management of the fund itself. How do leverage ETFs, if it's possible, even compare this? How do they stack up with kind of the non-leverage ETFs in terms of like fees and MERs and things like that?
Yeah, and you kind of alluded to it, because there is a lot going on these ETFs. There's daily trading involved, and there's a significant amount in terms of those financial derivatives we've been talking about. They tend to have a higher expense ratio than a traditional buy and hold ETF. But again, I think investors should be less concerned about that because they are very short-term in nature. If you're buying and holding an ETF over a year or several years, you want to know what that MER is, because that's going to be a little bit of a drag on your performance on an annual basis. If you're using a leveraged ETF for a day or 2-3 days, that annual fee divided by 365 days becomes a very, very small amount. It's more about making sure that the solution operates efficiently and is giving you the exact exposure that you're trying to get.
All right, Chris, you mentioned that these ETFs are generally intended to be held for a single trading day. What might happen if an investor decides they want to hold them for a longer period of time?
Because these ETFs reset that leverage amount on a daily basis, the amount of daily return that compounds together is going to lead to a total return over a longer period of time that might start to drift away from that pure 2 times exposure or negative 2 times exposure if we're talking about the inverse leveraged ETFs. So we have put a table together that shows in a couple of different market environments what your return experience might look like using a 2 times up or a 2 times down ETF. So let's assume, for example, that we have an underlying index or an underlying investment over a 5-day period. Let's assume each day that investment goes up by 10%. So 5 days of 10% return, you compound that together, and that overall return for that period would be 61% for that underlying investment. Now, if we take a look at the 2 times levered ETF, each of those days, it's compounding a daily 20% return together. And so at the end of those 5 days, it's compounded 20% 5 days in a row. You're actually going to get close to 150% as a total return. So, I mean, that's a great outcome for sure. But if you compare that to the 60% return of the underlying, and you're naively just doing the math and thinking, okay, I'm going to get 2 times that, I'm going to get 120%. You can see that it does start to drift away from that. In this scenario, it works out for the investor in a positive way, but it can certainly turn out the other way as well. If we take a look at, using the similar example, what a 2 times daily bear ETF would look like in this scenario. Again, you're compounding a negative 20% return each day. Your total return over that period is going to be a negative 67% for that 2 times negative bear. Now that's actually only about kind of 1 times negative that 60% return that underlying index would give. So again, not quite as intuitive in terms of what that total return experience looks like if you're only looking at that return over a period of several days. So the greater the volatility of the underlying investment, the greater the movement of up and down, again, not directional, is really going to start to drift these total returns over a period of time away from that pure 2 times or that negative 2 times exposure.
Now, outside of an investor's own prerogative just to do what they want to do in their own portfolio, is there a situation where it might make sense to hold it longer term than just a day or a couple days?
Yeah, I think, if an investor, again, has a view on a particular underlying market or underlying asset, it really depends on the directionality. Upwards trending markets or downwards trending markets, if you have a few days in a row of the underlying asset moving in the same direction, you might be okay to hold on to that leveraged ETF and understand that you're probably going to get a similar return experience. It's really when you start to see the ups and downs on a daily basis where you're going to start to deviate from, again, that pure 2 times or that negative 2 times exposure that you're going to get. So, you can certainly do that. You can certainly hold these more than one day if you need to, but it really comes down to the path dependency of that underlying investment, how close you're going to get to that 2 times or negative 2 times return.
And that volatility that you're mentioning and the swings in price, that's all something that all investors that are engaged in the market are probably pretty used to by this point in time. So with all that we know now, what type of investor might want to use these products?
Well, again, there's a lot going on in these solutions, a lot happening under the hood. And so I think sophisticated investors that really understand the mechanics of this, a lot of the compounding effect that we've just been talking about, and understanding how that might affect their portfolio if held for a long period of time. Investors that understand what that underlying investment is and how it moves and the volatility associated with that underlying investment, because again, the volatility directly plays into if you do hold it longer than one day, what's your total return experience going to be like? And then, of course, you need to have the time to actively monitor your positions. If this is a solution that is only going to be held for a day or less in your portfolio, of course, you need to have the time to monitor that position, be able to buy when you want to buy and be able to sell when you want to get back out.
You're right. Now, timing the market can be challenging, but you need to have the ability to kind of be watching it, especially when you've got these really short holding periods that we've been talking about. Now, what are some examples of situations in which an investor or trader could aim to use a highly leveraged ETF to their advantage?
Yeah, and as we say, this is really about market timing in its purest form, right? This is about taking a bet or position on an underlying investment that you have a strong conviction in. So if any investor or trader feels very strongly about the direction of an underlying asset movement, capitalizing on that by using a leveraged exposure can be a great way to do that. Also, if there's something happening in the market, a particular catalyst, whether that's a Fed announcement or an earnings announcement or a release of crude oil inventories, there's a lot of different market moving events that can have an outsized impact on an underlying asset's price. And so trading in and around those sort of events using Beta Pro solutions or leverage solutions can make a lot of sense also. And then also you can think about it as more of a risk control type of strategy also. Imagine you're long an underlying investment like the S&P 500 or the NASDAQ, and you're concerned about an upcoming event and the impact that might have. You might not want to necessarily sell that investment you have. Maybe it'll create a huge capital gain because you've held it for a long period of time and you don't want to necessarily realize gains in your portfolio. You can take a position in the inverse ETF of the same underlying investment and really hedge that long exposure that you have and be able to take that off in short order as well if you want to protect your current investments to some degree and then take that back off to again gain the full upside exposure to that.
I like the way you put it. That's kind of an efficient way to manage your account. We don't need to be needlessly taking like taxable events in our portfolio and things like that. And now when we're thinking also, just to kind of pull on that thread around hedging, Is this, am I thinking about this correctly? This maybe allow us to not have to kind of like one for one hedge. We can take it more of like a lack of a better term, like a ratio to what we're doing with our portfolio.
Yep, that's exactly it, right? And so again, let's assume you have exposure to the Nasdaq and you have a, let's just say a round number, $1,000 invested in the Nasdaq. You can buy a leveraged or an inverse ETF to protect against that, but you don't have to protect against the entire $1,000. You can put $100 to work or $200 and have a partial hedge in place. Of course, if you're really bearish or really concerned, you can hedge that full amount. But it's really up to the investor, and that's one reason why these are such great tools. You can size that position accordingly to what other position you're hedging and the degree of confidence you have in that underlying market movement.
So these moderately leveraged ETFs can offer greater upside as well as downside risk. With that in mind, let's talk about some best practices when investors and traders are holding them.
Yeah, so again, it's really about thinking about holding these ETFs for a short period of time, as little as one day or even less intraday. And really, again, that goes back to they're not built to be buy and hold solutions, and so over time, that could lead to a return that's different than your expectations. So really consider holding these for a short period of time, and really make sure you understand the characteristics of the underlying investment that you're gaining exposure to, the volatility of that investment, and the pricing around that as well. And of course, I think, in general, ETF best practices for any ETF really is maybe try to avoid the first few minutes of a trading day. The market tends to open at 9:30, but not every underlying investment trades immediately at the open. And so allowing the market to open, giving it a few minutes for all those underlying components to trade and give market makers and the market confidence on the value of that top ETF will keep your spreads nice and tight as well when you want to buy and sell and get in and out. You really want tight spreads for that so that you're not spending too much in terms of that trading cost.
Okay, Chris, thanks for explaining the ins and outs of leveraged and inverse ETFs. Now let's take a moment to hop into WebBroker to show our viewers how they can get their research started on these products.
Now the screeners can be found under the Research tab at the top of the page. And under the Tools column, go ahead and select Screeners. Now, there's lots going on this page. You can choose screeners for particular stocks. You can identify particular technical events, and we can screen for mutual funds, and what we're focusing on here today, ETFs. On this page, you've got some predefined featured screens on the left-hand side. And then if you'd like to create a custom screen based on your own criteria, the button's over here on the right. Now here's where all the magic happens. We have all of our different categories listed on the left-hand side. Then we have all of the subcategories found within on the right-hand side. I'm going to be spending most of my time on the overview page. Now, first of all, if we look on the right here, inverse happens to be one of the criteria we can add. That was a big part of our discussion. Let's go ahead and get that added on. After I've selected inverse, take a look off to the right-hand side. Next, let's go ahead and add that criteria. Let's add a few additional ones in here while we're at it. Let's go ahead and make this leverage. That's what the flavor of the day is. So I'm going to go ahead and select leverage. I'm going to add that criteria as well. The last one on this page is index. So I'm going to be focusing on index ETFs, kind of a popular screening category as it stands. Let's add that criteria. Lastly, as I mentioned, all sorts of broader categories on the left-hand side as well. For our purposes, I'm just going to go ahead and choose price and trading volume. What I'm going to select here is trading volume. Here, this particular criteria will help me identify stocks that are trading above their normal volume over the last 2 trading weeks. Let's get that added in. All right, next step in the process. Once we've chosen all of the criteria, we need to refine it. In terms of the country, that's preloaded. I'm going to leave that blank so I can cast a wide as net as possible. In terms of inverse, we added that on. So yes, I want to make sure that's only finding inverse fund for me. Same thing with leverage. We want to be finding leverage only. Index was another criteria where only one index, or you can choose no index, but clearly that's why we added it, so we can find only index funds. And lastly, in terms of the volume, I want to find only the highest traded volumes above their average in the 10-day period. Now, before we go ahead and view the matches for these specific data points, just note that when you're doing an ETF screen, it automatically is going to include mutual funds in that screen. For our purposes, I'm going to uncheck that and find it. You know what? Lo and behold, it didn't actually change the number of matches. So let's send that through and view the 46 that meet the criteria that we laid out. All right, so here you have it. We've got the 46 matches laid out for everybody. We've just got the screening criteria up here for you, but you have an opportunity to look at either profiles, ratings, performance, what have you, on each on all of the funds against each other. On the ETF screener, you can compare up to 5 different ETFs against each other. Let's choose a few at random here. So we've got. Let's see what we've got. We've got a daily bear S&P. Let's go ahead and choose that one from Beta Pro. Let's go ahead and look and choose a couple other lists that kind of are along the same range. We've got a daily bear financials. We've got an S&P from Direxion, and maybe just choose one more for our purposes here. We've got this is more sector specific. We've got a semiconductor bear fund. So we've chosen those funds that we're interested in. The next step is to choose compare at the bottom of the screen. So here we have it laid out in a really kind of easy to absorb manner. We can really get a sense of how each fund is looking compared to the other. If you're ready to make a buy, you've got the buy and sell buttons. They're going to be available for you at the top of the screen. But if you'd like to dive in and do a little bit more research on a particular fund, simply just go ahead and click on the fund's name at the top of the page. You're going to have this pop-up menu that shows you a quote as well as a really basic line chart. But down towards the bottom of the screen, you have the opportunity to look at a summary. We can look at a detailed chart. We can even begin setting alerts if you'd like to be kept informed and not have to be at your computer all the time.
We're going to have to leave our conversation there, but we're not done yet. We're going to open the floor and take questions from our audience. Are you ready to take some questions, Chris?
Absolutely. Let's get to it.
Have more questions? Check out the links to the right and in the description below.